the key question what people are asking us now is, with the election over and having a comprehensive win for the coalition, what's going to be the impact of the new government, not only on the economy but also on the markets. You know, when we have a look at the markets and the history of Australian government changes, what we can see is that if outside the GFC, the average return for a first-year government is 11.8% since 1901. And that is precisely the same return that Australian investors have received in accumulation return, terms since 1882. So really new governments, whilst the confidence might be a bit higher, they actually don't really change the return dynamics at all. And so really the key impact then on the market from the new government is going to be, well, what are they going to do on the economy? And obviously there's some well publicised policies they're going to implement, but in the end, governments don't really have a big impact not only on the economy but also on the markets. So most of the economic output and the earnings growth that companies achieve really is driven by the private sector. And so really the best job that any government can do at the moment is just kick the stone out of the way and let the grass grow. Let corporations create the wealth and create the employment. And I think that really is what the aim of this new government will be. When we actually turn our attention to the Australian economy though, what we can see is the economy is still continuing to slow down. What's remarkable about the slowdown is actually how progressive it's been. It's continued on for around a year, but it hasn't dramatically slowed down in any one quarter. Growth's now running at around 2.5%, and it will progressively slow further from that. But the odds of recession at this moment in really the key year being 2015-16, the odds are still pretty low at around 25%. And while some people may say that's quite high relative to the last 22 years, it's still a 3 in 4 chance that it won't happen. What that really also tells us is that earnings growth is going to become a bit more difficult in the Australian economy. Now at the moment, earnings expectations for the Australian share market for the second half of this year are running at around 14%. And that's extremely high. When I look at the economy, I can see nominal growth of around 4 or 5%, which means that earnings growth will be around 7%. Now, that's probably half what the expectation is, but since about 1990, the average earnings downgrade at the start of each financial year is around 7 percentage points. So to me, FY14 is really going to be no different to any other financial year. And that is earnings will come down, the market can still rally. You know, the key really is going to be is revenue growth, because that's going to be primarily what will drive earnings outperformance. And so therefore I think investors just can continue to look for positive returns in those quality businesses who have strong balance sheets and those real good surplus cash flow generating business models. I mean, that is the key to wealth creation in any cycle, and I don't think this financial year is going to be any different.